A rise in crude oil prices may look like a fuel story. For markets, it can become much bigger. Crude oil is a base cost for the economy. It affects transport, shipping, manufacturing, and logistics. When oil rises, these costs can move through the economy and push inflation higher. Higher inflation makes central banks cautious. Rate cuts may get delayed or rates may stay higher for longer. Bond markets react to this. When inflation or rate expectations rise, bond yields often move up. This matters for fixed income investments, including debt mutual funds. Interest rates and bond prices usually move in opposite directions. When rates rise, bond prices typically fall, which can impact returns from certain debt funds. Different debt funds respond differently. Shorter maturity strategies may see lower rate sensitivity than longer maturity strategies. This makes horizon and risk profile important while evaluating choices. Across major economies with higher inflation led by crude price surge, bond yields have started pricing in rate hikes. In this environment, fixed income investing is not only about predicting rates, it is about balancing yield, maturity, credit quality, and risk based on your investment objectives. Explore debt mutual fund options and fixed income insights on HDFC Bank SmartWealth based on your investment profile and horizon.